What if America's worst crash began with a barber's stock tip? October 29, 1929, Black Tuesday. The day your grandmother's investment advice became more valuable than advice from a Harvard MBA. Because when barbers, bellhops, and bootleggers are all giving stock tips, you know the party's about to end. Remember our Dutch tulip traders from 1637? Same delusion, different century. Because humans never learn, we just find new ways to convince ourselves that this time is different. This is the Capitol Files. And today, we're opening the classified files on the day America discovered gravity still works. Picture 1920s America. Jazz was hot, credit was cheap, and your mailman was richer than your banker. The Dow Jones had gone from 71 to 381 in 9 years, a 400% increase that made everyone feel like Warren Buffett. Here's how crazy it got. Your shoeshine boy was giving stock tips between polishes. Housewives were speculating between cooking dinner. Even the guy who cleaned office buildings owned more stock than cash. The psychology was intoxicating. When your neighbor bought a new car with his stock profits, you felt stupid for keeping money in the bank. When your barber recommended Radio Corporation stock while trimming your hair, you listened. After all, he'd been right 3 times already. Let me show you how the game worked and why it wasn't a game at all. You want $1,000 worth of stock, but only have $100? No problem. Your broker loans you the other $900, using the stock as collateral. When it rises to $1,200, you sell, pay back the $900, and pocket a $200 profit on your $100. That's a 200% return. Modern crypto traders would call these rookie numbers. In 1929, some people were buying stocks with just 10% down. It was financial Russian roulette, except most players didn't realize every chamber was loaded. But the real madness was investment trusts, leverage built on leverage built on leverage. Picture this. Trust A buys stocks with borrowed money and sells shares in itself. Trust B buys shares in Trust A, then sells shares in itself. Trust C buys shares in Trust B. You get the picture. It looked like a pyramid of leverage in a 3-piece suit, and nobody wanted to ask what happened if the bottom collapsed. By September 1929, the red flags weren't just visible, they were on fire. Stock prices had no connection to company profits. $8.5 billion was invested on margin, borrowed money. Interest rates on margin loans hit 20% annually. Even the Federal Reserve was panicking about speculation. But warnings sound like jealousy when you're getting rich. The party was too good to question. October 24, 1929, Black Thursday. The first crack appeared when stock prices began falling at the opening bell. Not crashing, just falling. But in a market built on borrowed money, just falling becomes catastrophic collapse real fast. Here's what made it a nightmare. The stock ticker couldn't keep up. These mechanical ticker tape machines could process maybe 285 words per minute on a good day. On October 24th, trading volume hit 12.9 million shares, nearly 5 times normal. The ticker was running hours behind reality. It was like trying to drive 60 miles per hour while looking in a rearview mirror. Investors across America were making life-changing decisions based on prices that were already ancient history. Here's where physics met finance, and finance got destroyed. As stock prices fell, margin calls went out by the thousands. Investors who couldn't pay up had their stocks sold automatically, which pushed prices down further, which triggered more margin calls, which forced more selling. One Lehman Brothers partner described the scene. The phones never stopped ringing. Every call was the same. Sell everything. I need cash now. But here's the cruel mathematics. When everyone needs cash at exactly the same time, cash doesn't exist. October 29, 1929, Black Tuesday. 16.4 million shares traded hands, a record that wouldn't be broken for nearly 40 years. The Dow lost 12% in one day, bringing the two-day drop to 23%. To put that in perspective, imagine the S&P 500 falling from 4,000 to 3,080 in 48 hours. Your retirement account, your house down payment, your kids' college fund gone. In downtown Manhattan, crowds gathered outside the New York Stock Exchange like mourners at a funeral. Inside brokerage offices, the scenes were apocalyptic. That office clerk who had mortgaged his house to buy stocks, homeless by Tuesday afternoon. The widow in Ohio who invested her husband's insurance money, penniless. The young Chicago couple who mortgaged their farm to play the market. Their American dream just became an American nightmare. Margaret Sullivan, a secretary from the Bronx, watched her life savings disappear in a single phone call. She'd been planning to buy a small house with her brother. By closing bell, they were figuring out how to tell their parents they'd lost the family emergency fund too. At Merrill Lynch, a middle-aged accountant sat motionless for 3 hours, staring at his margin call notice, like a man who had just discovered physics still worked. These weren't greedy Wall Street speculators. These were regular people who believed the promise that anyone could get rich in the stock market. They learned the difference between promises and reality in the cruelest way possible. The stock crash was just the first domino. What followed was worse. Banks had invested heavily in stocks and made loans secured by stock collateral. When stocks became worthless, banks failed. Between 1930 and 1933, over 9,000 banks went out of business. People lost not just their investments, they lost their savings, their deposits, everything. Unemployment exploded from 3.2% to 25%. Bread lines stretched around city blocks. The Dust Bowl turned environmental catastrophe into economic apocalypse. The same neighbors who had called you old-fashioned for keeping money in banks were now sleeping on those neighbors' couches. America had spent a decade believing financial gravity was optional physics respectfully disagreed. President Herbert Hoover's response? He doubled down on delusion. Standing before a nation in freefall, Hoover declared, "The fundamental business of the country is on a sound and prosperous basis." It was like declaring the Titanic unsinkable, while standing knee-deep in seawater. Spectacularly, historically, catastrophically wrong. It took Franklin Roosevelt's New Deal bank holidays, FDIC insurance, securities regulation, to even begin rebuilding trust. But the damage was done. An entire generation learned to distrust markets, banks, and the promise of easy money. Here's the uncomfortable truth we keep ignoring. We keep making the same mistake with different assets. 1920s, margin trading on stocks. 1990s, day trading on dot-com companies with no profits. 2000s, subprime mortgages packaged as safe investments. 2020s, options trading on meme stocks and crypto leverage that would make 1929 speculators blush. The tools evolve, but the psychology is identical. Cheap credit, rising prices, and the dangerous belief that this time is different. Black Tuesday didn't cause the Great Depression. It revealed it. The crash exposed how excessive leverage and speculation had turned the entire financial system into a house of cards. From tulip bulbs to tech stocks to mortgage securities, the pattern never changes. When everyone believes prices only go up, someone always gets to hold the bill when gravity returns. So here's the question that should terrify every investor. What's today's version of 1929? NFTs? Crypto? SPACs? Meme stocks? The next crash won't look like the last one, it never does. But the warning signs will be identical. Easy money, impossible returns, and everyone from your barber to your Uber driver giving investment advice. The cruelest irony? The people who mocked conservative investors for missing out were now learning that missing out on disaster is actually called wisdom. This has been the Capital Files. If this story of America's most famous reality check revealed how we never learn from history, hit that like button. Subscribe to the Capital Files for more investigations into the moments that changed everything, and tell us in the comments, what's today's version of your barber giving stock tips?